let's get to today's big moves. We've got Yu-Dee, Ace Investment Strategist, Chief Trader, with 2 ways for you to play the market and stay ahead of all of this volatility. We also have Todd Horwitz as he's in the pits of the CME. Todd, let me go to you first. Wow, what an interesting day it has been. How would you summarize it?
Hi, Ashley. Hi, Liz. I think today was really a big thud. When it all came down to it, all the expectation of what the Fed may do, we got right up to resistance. They came out with the announcement, and we sold off a little bit. You know, the whole scuttlebutt from May 22nd to today, from when we collapsed, it's all been on the same news. So yesterday's news became good news, and now the bulls are a little bit tired here. I think we probably take a little bit rest right here about 1650, 1660 in the S&P.
Oh, it's a little bit of a misnomer to say, wow, look at the volatility today. I mean, it was a couple of points up, a couple of points down, a very narrow range, correct?
Yeah, it was a market that, you know, had feel to it, but it really didn't have. I mean, actually, if you look at it today, was probably one of our tightest ranges of the week. So when you go back, we've had a number of triple-digit days in a row where we've been flying up and down. So today was really pretty basic and pretty quiet because the news came out, you know, and it was just that was exactly what everybody expected. A little bit of a burst, a little bit of a sell-off, closing right around the flat line.
I don't know, Todd. I saw the sell-off in the dollar, which was interesting because I felt like there was no clear timetable that perhaps was expected, and the timing of all of this remains open. We saw the dollar go down, and we saw gold get a nice spike.
You know, gold was due a little bit of a bounce. You've had a situation where gold has been just getting pummeled almost every single day, so it's due a bounce. I wouldn't expect it to go past 1275. You take a look at the dollar. The dollar has had a tremendous rally here. The euro being under tremendous pressure, so that takes care of that. And then, you know, the rest of the markets are just, you know, we're showing that we're going to be okay. And the biggest thing that we're missing here is the interest rate market. You know, although the Fed says they're holding the taper, interest rates are going higher.
Yeah.
And right now, the markets have control, and the bond futures are going lower, which are driving rates higher.
It's not necessarily a horrifying nightmare if they do go slightly higher. Wait, can I bring Yu-Dee into this? Yu-Dee, the markets are not fearing taper talk today because we did get some insight into what the Fed has been talking about from those minutes from the June 18th, 19 meeting. And some of these members are saying, you know, we got to end this or at least start tapering by the end of the year.
Yeah, and don't forget, the market had already reacted to it back in May, right? So you're right, we're prepared already. And also, if you look in history, Liz, the initial part of interest rate rise in history has proven to be good for the stock market because that's when the economy start to heat up, start to recover. It's only at the latter stage of the interest rate rise that really hurts the market. So I think for the time being, the market is kind of moving on, saying, okay, so we're going to taper down a little bit, but right now it's really back to the economics and back onto the earnings.
Well, Yu-Dee, the last time you were on this show back in May, you called for a correction for this market of between 5 and 8%. We've seen a 5% dip. Is that it? Where do you expect the markets to go from here?
Yeah, believe it or not, I think going forward, at least pretty much until the end of October, I expect what Todd was saying for today. Nothingness, basically, a little bit back and fill is what I mean. You know, we had a target coming into this year of about 18% rise in the market. S&P is up about 16. So I think maybe there's 2 more percent to go, meaning a couple percent up, couple percent down, basically going nowhere.
And Todd, it's such a cliche to say, but people have particularly missed out on this rally because they were terrified and they did not remember the old adage, Wall Street climbs the wall of worry.
And that's a great point, and a lot of people did miss this, but one of the other problems is this rally has been a lot driven by the cheap money situation, and unfortunately, a lot of the average traders don't have the same benefit to get that cheap money to get involved in it. You know, the average Joe hasn't been able to participate borrowing money and being able to invest in the market and increase their dividends. So this has been an event-driven market, but it's really been driven by the upper 1% of the class and by the very wealthy, and the average Joe really has not participated, partly because of the wall of worry and partly because they don't have the same advantage of the funds that they can get to like everybody else.
All right, Yu-Dee, if the average Joe comes to you, where do you tell them to put their money?
So you're calling me average Joe, but okay. Basically is this. I think on an overall basis, I don't expect much. But on sector basis, if you pick the right sectors, I think you can still see a lot of return. Home builders, no doubt, is still a sector I like. I think we've seen only the beginning of a multi-year rise. 2012, home builders went up a lot, 13. This year, basically, they've consolidated. They're at the lower end of their range. So like the home builders, home builders such as Toll Brothers will lead, maybe even an entire index of ITB. Another sector I like is the financials. As interest rates start to go higher, these financial companies are going to get better margins, thus higher stock prices.
Okay,
so
but we're just showing these sort of amorphous ETFs. What are your names that you like?
Yeah, I think on the financials, I like Goldman. That's the gold standard of financials. I like the Goldman a lot. If you look at it, their earnings growth, even their valuations, only about 11 PE. Also, I like Capital One. They're growing, they're Viking. They're sending Vikings out, and they're taking over the credit card world. So their profit margin has been up as well. So I like that. I think as far as the home builder is concerned, I like mostly all of them. But if you want me to pick one or two, like I said, Toll Brothers. I think they're on the higher end of it. I think Toll is pretty much at the lower end of this range, 30 to 38. I think there's a lot more to go. Toll Brothers.
Yu-Dee, are you concerned about these regulations that are being piled onto the banks now, that will eat away at those profit margins that you were talking about and offset the benefits of rising interest rates?
Yeah, I think that is a little bit concerned there, but don't forget, those concerns have been there for a while. I think, again, most of these financial stocks have discounted those concerns already. So I think going forward, unless they come out with more stringent, even more rules that we don't know of yet, I think basically that's the old news. I think the new news going forward is these financial companies are getting much healthier. Their book is getting much more solid. Now, if they could raise their profit margins based on higher interest rate, they could even make more money and bring up the stock prices.
Yu-Dee Chang, Todd Horowitz, we're going to check back in with you guys in just a few minutes to see how the S&P futures close, because it was a very close one today, wasn't it?
It was.
Thanks, guys, very much. The man with